Boris Pikalov, co-founder and chief analyst at Stobox. Adam Buktilov, co-founder and project lead at Defactor.
Dear viewers, welcome to another issue of Stobox Interviews, where we speak with industry leaders about the future of real-world assets. And today I have a pleasure to speak with Adam, who is co-founder at Defactor. Adam, it's a pleasure to welcome you today.
It's a pleasure to be here. Thank you for having me.
And let's dive right into the discussion. Tell us please more about the Defactor. What is your business model, service you provide, and where do you see yourself in the real-world asset industry?
Okay, yeah, great. Well, again, thanks. It's great to be here. So I'm Adam, co-founder at Defactor. Defactor is all about real-world asset technology. So I like to joke and say that we've got a Swiss Army knife for RWAs. So as new projects come in, we've got modules for tokenization. We have a model for lending and borrowing. So for using tokenized assets as collateral for loans, kind of bringing DeFi to RWAs. But also for projects that have their own token. We've got staking, we've got governance. As I say, with this RWA toolkit, we're really trying to help projects as they come online, when they make that decision. Should they build something themselves in-house? Should they use something that's already out there? We hope that they would choose Defactor.
I really like the analogy of the Swiss Army knife, and we have a similar story at Stobox. We started seeing ourselves as purely technology company in 2018, but what we have found is tokenization is more than just about technology. It's also about the proper financial audits, about legal disclosures and structure. And so we expanded into providing a broader set of services, which we call a turnkey solution. And the moment when we shifted into that, this is where we really started seeing that growth. So yeah, it seems that that was exactly what the industry needs. And it's interesting that you also have discovered that it's much more preferable to be a Swiss Army knife.
I think it's important. If you check now on like CoinMarketCap or CoinGecko, there's approximately 150 to 170 projects that classify themselves as RWAs, but they have, their own token. And what I think actually in the next 12 months is that's going to go more towards like 1,000 projects. So as we get to that point, we really will see a huge flood of projects that will need these services going forward.
Yeah, that's quite likely, and it has been heartwarming to see the growth in the last 2 years. I remember when we were just starting out, and it was really like fighting an uphill battle. There was no yet established infrastructure, no recognition in the market. Like I remember back then, each my client call, I had to explain, no, real world asset tokens are not the same as Bitcoin or ICO cryptocurrencies or meme coins or whatever. Now I don't really have to do it at all. We are even remaking our website because now we don't have to spend that much time on the landing page explaining what tokenization is, and we can focus on actually the service that is being provided. And this is a nice segue to proceed into my first question, which is whether you believe that the hype about real world assets is justified. Will we really see 1,000 projects in a year or two? And if we do, will it grow even further, or the industry will fall back to like 100 projects in 3 years when the hype goes down?
Yeah, it's a really good question. And what's funny, I came into the blockchain space maybe 7 years ago. And at that time, we were talking about a lot of the same things. We were talking about the tokenization of assets, whether that's real estate, financial assets, security tokens. It just didn't have the name RWA, right? So it didn't have that hype at the time. But also a lot of projects weren't ready yet. You had the big banks, big institutions. They were doing more testing, proof of concepts, writing papers about this space. But now, as it's kind of come full circle, you've obviously got some of the biggest asset managers and companies in the world, BlackRock, Fidelity, all of these people that are looking at the tokenization space. So I do think that the hype is justified. I mean, when you look at some of the benefits to bringing assets on chain, whether that's for additional liquidity or utility or access, I don't see this space going away. Now, my prediction, as I say, is there's going to be a flood of new projects coming on, whether everybody makes it or not, or as they say, we're all going to make it in crypto world, who knows? But what is true is from all over the world, Doesn't matter the jurisdiction, you're going to have projects coming online and basically exploring this. And that's why it's up to projects like Stobox and Defactor to make it as easy as possible for them to test these business models.
I agree. What we have found is that this ease of tokenization is one of the major factors, because previously, when the cost has been significantly higher than it is now, and then when there was more uncertainty whether the project will make it or not, like even whether they will be even able to issue the token, that was one of the major deterrents, especially from risk-averse projects. And we had kind of this problem when the projects that were most willing to move forward were the ones who were the most desperate. But the ones who are most desperate are the ones with the worst assets, and therefore the ones least likely to succeed. So there was a chicken and egg problem in terms of getting this launch. And I believe the current hype is what allowed us to finally break through this chicken and egg problem in terms of having high quality projects and investors being interested in them, and probably institutional hype like BlackRock and others finally going, if not all in, then probably just significantly then testing, going into that in terms of their branding and putting their reputation at stake is what really propelled this forward. So this is interesting because crypto industry started in terms of being anti-authority, in terms of building the alternative financial system. But now we are kind of following the large institution and saying, yay, Bitcoin's gonna grow because now the major institutional ETFs are coming on, and RWAs are going to be big because BlackRock came in. So there seems to be this inherent tension between, is the future community-driven or is it institutional? And I'm wondering to hear your take on that. Like, are we going back into this into institutional investors dominating the industry, or is it still becoming more decentralized and community driven?
Yeah, it's a really good point. What we have at the moment is kind of this push and pull from people that were the kind of crypto anarchists of no, everything has to be on chain, you know, as they say in the Bitcoin community, you know, don't trust, verify, you know, all of this stuff is, and that still remains the case. However, when you look at real world assets, it's in the name, right? The assets are in the real world. And a lot of the time you do need, whether that's custodians, whether that's legal advisors, whether that's people to verify that the assets are there. So you're always going to need, I guess, some type of institutional involvement or centralized involvement in that. However, what we're seeing at the moment is lots of these RWA projects have their own token, or they have their own initiatives to try to bring on the community. So I don't necessarily see the future fully decentralized. I think there's going to be a balance, and it will really depend on the types of assets that we're talking about, you know, whether they are securities, whether they are financial assets, whether it's some more exotic flavors of what we're seeing now. I think it's going to be a mix, to be honest.
Most likely, yes. I tend to agree with you. Probably the most promising direction towards increasing decentralization that I observe is that institutions themselves becoming more decentralized and community-driven in two respects. Firstly, in respects of their marketing, like being more focused in terms of publicity, in terms of being present in social media. And even though technically speaking, people on Twitter don't have the power to impact decision-making, like legal power to impact decision-making somewhere at BlackRock. Realistically, when a lot of your marketing and branding is tight into speaking to the community, you're more likely to be shifted by the community opinion. So this is one point where I see the industry becoming more community-driven even without legal change. Second, and this one is the one I'm even more excited about, is the legal change in terms of the ownership and governance becoming more sophisticated and including more community initiatives. So, for example, giving a vote or a stake to the broad community, even if they aren't investors in the, let's say, they are an investor in the BlackRock and the managing company itself, but they do participate in their project, maybe multiple projects, etc. Then or maybe they are service providers. There is definitely a space in terms of bridging the gap between shareholder capitalism and stakeholder capitalism by giving more voting power and governance power to different groups of stakeholders.
No, that's really well said. And I do think we will see a lot more of this, whether it is, you know, DAOs or decentralized autonomous organizations, or whether it's going to be, as you said, giving the community a say. You know, this is a unique time in the world. It's only in the past 10 to 12 years, are people kind of comfortable with, social media, voicing their opinions online, and now starting to bring that on chain and giving people a way to signal, hey, look, I like the direction of this or not. It's almost like, of course, we had shareholders and shares with voting rights, etc. before that, but it can now go a lot more widespread. And this can be, global initiatives that people from all over the world can be a part of these. And that really can be community driven. But back to, as I said, I still think you will have that element of, you will need either real world actors there, whether that's people, as I said, custodying the assets, providing efficient pricing, all of this stuff. So I don't necessarily see it being fully decentralized. Nobody knows who's doing anything. However, with technologies like ZKs or zero knowledge proofs and stuff, we may get to the point where there is a lot that can be done on chain and autonomously.
It's good that you mentioned zero knowledge proofs, because probably in terms of blockchain, on the technological level, ZK proofs are the one I'm the most excited about, or at least probably alongside account abstraction. The reason for that is because generally what I like about technology in progress is solving dichotomies. Like previously we had this dichotomy between privacy and security and enforcement, and now due to ZK proofs we can transcend this dichotomy and have both. And why not have both if you can? And similarly with account abstraction, we can have both decentralization and proper user experience. And if we truly want Web3 to be the next iteration of the internet, we probably wanted to transcend the dichotomies, the conflicts of Web2. Otherwise, it's no better.
Yeah, completely agree. I think that's very well said.
And how about your experience at Defactor with companies you work with? Do you see them trying to utilize these cutting-edge technologies and going into more community-driven direction?
It's definitely a mix. So at Defactor, we've got a whole bunch of projects that are maybe Web 2 natives, so they didn't really come from the crypto world, and they're looking to us to say, well, guys, what concept should we be looking to enact here? And then you've got others that are Web3 natives, so they really want to make sure that they're putting things like staking and governance at the heart of what they're doing. And as I mentioned before, we have the technology for that. We have a module called Engage, where projects are able to create their own staking pools. They can do really exotic ways of, signaling and supporting for different things, as well as governance. But I would see probably more of the former, where it's projects that are, let's say they're real estate specialists, or they're specialists in luxury goods or their own business. And now they look to this world as a way to offer additional options, additional utilities, additional incentives to some of their users.
We have a lot of similar experience. Many people, I would say the split is about 70-30. That is 70% of clients who come to us also are Web2 natives. On the first call, they say us, hey, I have no idea how crypto works. I just see that this is super exciting and I want to be a part of that. So yeah, and they are often cautious about giving voting rights, though what I noticed is sometimes it comes not from the inherent desire to control, but more from lack of understanding or experience. They just don't know how this can work, or are a bit scared of giving away power to investors, not knowing whether the incentives would be aligned. So having, first of all, success cases like the ones you're doing in some of our cases who are more community driven, and also importantly having tools to make it easier, operationally easier. This is probably the key in increasing the share of our clients, even the ones who might be a bit hesitant at first to move into this more interactive space by working with their investors. And this definitely has a benefit. For example, in terms of the research on success, we consistently see that projects who are more willing to engage community, more willing to be transparent, open, and on the legal level just provide voting rights, have higher success rates compared to the ones who try to do everything in an old way.
Interesting. Yeah, I guess I can see that, and I can see why. I do always try to advise our clients and our partners to start small, though, especially if they are coming from the Web2 world. Some of these concepts seem very exotic, and why would I do this? I don't want people telling me what time I should wake up in the morning or what I should do. I should distribute dividends. But no, start small. And Another thing I always say to these projects is, remember, this community engagement, it's not something that you do once and it's finished. It's an ongoing thing. You have to consistently work with the community, try to make sure they understand your roadmap, what you're building, and bring them in on some of these discussions. Then they feel more confident to be able to contribute. And you'll start to see, like what we see at the moment, the majority of our governance votes now, they come from the community to saying to us, guys, we've been looking and now we think we should close off this staking pool, or hey, why don't we introduce a burn, or we would like to do more events in Asia, whatever it may be. These things come to us because the community feels more confident to say, hey, I want to propose this now.
I love this framing. I love that we focus not just on the operational difficulties and making this easier, but also on the upside, that community engagement is not just about people being more willing to invest if you engage them, but also actively participating in the development and growth of your project in terms of potentially bringing customers. Actually, at Stobox, we do have a few customers who have been brought to us by, introduced to us by community members who first became investors of our tokens. So we already do have some successful experience with that. And we are getting advice from the community, let's say, on marketing initiatives. And we probably need to emphasize this more in discussing with clients the decision as to how much effort they should put into community engagement, that this is not just about the capital raising. This is also about the practical business benefit. I would say another benefit is also in terms of asset value, because obviously when you have more investors willing and excited, they would put higher premium on the price of your tokens compared to the underlying revenues. Like increasing P2E from the 8.5 to 10 might sound boring, but that translates into millions of dollars in value, and that is worth thinking about and caring about.
Absolutely, absolutely.
And as we are on the topic of investors, I'm curious to hear your opinion and your experience on who are investors in real-world asset, both utility tokens, project tokens, and the real-world asset themselves from projects you are working with.
Yeah, I'm glad you made that distinction, because there is a difference, and they're kind of different personas, right? You will get people, for example, that will buy the STBU tokens or the Defactor tokens, and they will do it purely out of speculation. Maybe they see what the project is doing and they say, oh, I hope there's going to be a God candle and I get 100x, and that's why they kind of come in. Whereas on the real world assets and on the products that are being tokenized and investors, you're seeing obviously institutional money is coming into crypto, but you're also seeing some crypto investors that maybe want to, de-risk or take some off the table from the crazy volatility of crypto world and put it into some, tokenized T-bills or tokenized real estate or something else that maybe is yield generating, but it's not necessarily as risky as, say, holding your tokens or holding your capital in maybe a more volatile asset. So I do think it's a mix. You have the crypto speculators or the degens, as we like to joke around and call them. And then you've got the people that actually want to diversify their investment and kind of get a little bit more there. I think there's a third. I think there's, because of, I guess, bringing some of these assets on chain, you're giving access to a lot of people in different parts of the world that didn't have the ability to hold a US Treasury bill or to hold a piece of real estate. This is places like Sub-Saharan Africa, some places in Southeast Asia, Latin America, etc. And now you're starting to see, albeit it's happening slowly, but people from these parts of the world starting to get involved, and whether it's tokenized gold or real estate or things that they can get their hands on. And to be honest, it's that cohort that I'm probably most excited about. You're talking hundreds of millions, if not billions of people that previously did not have access, financial access or utilities, etc. And now that they've been, brought online, almost everybody has a smartphone now, and everybody has the ability to create a wallet and transact. You're going to see a flood more people come from there. And that's actually what excited me the most when I got involved in crypto. It was getting people on that space that were, being able to get more access.
I agree that that's a fascinating opportunity, especially since the ones who are most vulnerable are most in need of good investment opportunities to secure their money, to protect it even from things like currency volatility, which can wipe out one's life savings, maybe not overnight, but in a year or two. So this is a huge issue, and given that access is definitely protecting them from these kinds of local risk, and therefore helping build this generational wealth that actually lifts countries out of poverty. So it's exciting to be part of that move. Though I would say another way in which tokenization takes part in assisting emerging markets to move into the developed market territory is also by helping fund and increasing access to capital in these kinds of regions. Today in the morning, I had a conversation with a funding agency that works with multiple projects across Africa, and they say the problem they face is the misperception of risk by investors. That is, because investors don't really understand the region, they perceive the risk to be higher than it actually is, and therefore the funding rates are higher than they should be, and they cannot just get capital at a decent cost. And what tokenization can do is, by unlocking the community funding, but giving access to a broader range of investors, institutional investors, and the ones who may be more open to different kinds of risk profiles, they can tokenization can enable more funding and therefore more development in these kinds of capital-starved regions.
Yeah, and that's absolutely huge, right? Because a lot of the times with a lot of these RWA projects or permission pools, a lot of the yields are very similar to what we would see in the TradFi world. So there's kind of a challenge. If you're an institutional investor out of Northern Europe, you can already get access to yields that are 5%, 6%, 7%, up to 10%. But in some of these regions, as you rightly said, you will have much bigger yields. It doesn't necessarily mean it's a higher risk, but it all does come down to, I guess, being able to trust who is it that's issuing the asset or issuing that type of product. And I think this is where blockchain helps us, because you can have a history and a breadcrumb trail of, hey, there's this entity based out of, I don't know, country X, and they have 10 years of solid trading history, and they've got X amount of years of always repaying their debts in time. And that should give investors from all over the world a chance to be able to invest in these regions. So that's really well said. It's bi-directional. It's not only the people in those places getting access to the tokens, but it's also investors externally who are able to invest in these countries. And hopefully, as they say, that the rising tide will lift all of the ships and maybe lift some people out of the situations that they're currently in.
Yeah, I really like your point that there isn't necessarily a higher risk involved in these higher returns. This is more because of pent-up opportunity, like low-hanging fruit that just haven't been used properly. Yeah. And the point about the breadcrumbs, it aligns well with what we are typically advising our clients, because we do often have very ambitious clients that see significant opportunities to effectively utilize hundreds of millions of dollars in capital. But I always tell them, you got to start small. Before raising 100 mil, raise 500K, raise $1 million. Show that you are able to deliver returns, have an on-chain history of transactions showing your dividend distributions and yield you generated to investors. And then if you do that, you will be able to raise 5, then 10, and eventually you get to slowly build trust and track record in order to raise the amounts of capital you want to do. Because this is tokenization is not a magic pill. It provides you access to capital, but this is still also about having good opportunity and being sufficiently trustworthy to raise the amounts of capital that would make sense. And that, on the other hand, this should also probably solve the risk issue, because it is risky if you don't have an idea about the region. But if you have this paper trail or blockchain trail of successful returns, then you don't need to know the specifics if you see that there is just a statistical history of successful repayments.
Yeah, absolutely. And some of this, emerging market asset classes are really exciting, but it's that we previously didn't have either access or we didn't have local representation there to be able to do it. So there's some really exciting projects. We were previously a part of the Outlier Ventures RWA Basecamp, and we were mentoring some projects as they were coming through. And there was one in particular which always kind of stuck with me. It's called Haraka. And these guys are trying to do lending and borrowing in the African market. Like they're in sub-Saharan Africa, especially countries like Kenya, Uganda. They already do a lot of lending and borrowing amongst each other, and the default rate is crazy low, because it's actually your social status is your collateral, right? You don't want to not pay back the loan because everybody knows, hey, Adam didn't pay back the loan. But the rates are a lot higher than what we would see in Europe or North America, or so again, I want to see more and more of these projects, and it's not always easy for them to come online. But that's why they need to look to projects like Stobox, like Defactor, like a bunch of others that can help people get from 0 to 1. That's what I always like to say. And you said it really well there. Don't, as they say, don't try to drink the ocean, right? Start small, do something that's successful, get some success under your belt, product market fit, and build and build and build. So we're still so early in this space. We really are, despite the fact that 7 years ago, I was talking about the same thing with customers. We are still in the early days. So we have to always keep reminding ourselves that.
I really like that project you mentioned about the lending and borrowing in Africa, and especially the point about reputation and social capital being the collateral. This is interesting from two perspectives. One perspective is how we are able to make non-fungible things, or at least intangible things, tangible and fungible. For example, with one of our UK-based projects, we're currently issuing social impact tokens. That is token that would represent a certificate of the social impact from a given donation. And previously, this would be something very nebulous, but now it can be recorded, it can be retired when that impact is used in the annual reporting, and it can be traded. And therefore, there can be efficient pricing of how much am I willing to donate for $1 of impact. So, and this could naturally can create an auction dynamics of, in as far as companies would care for social impact, they would be willing to pay more even for a smaller amount of impact, or at least we hope so. We will see whether there is that level of social responsibility. But another interesting perspective is, it seems the reason there is low default rate is because the lending and borrowing is happening between people who know each other, and therefore there is social capital at stake. I'm wondering whether this won't be lost when we move to pseudo-anonymized blockchain environment, where this is primarily about protocol and statistics.
Yeah, that's a good point. And I think with this project in particular, again, they're starting small. They've done their proof of concepts, I believe, with a couple of communities there, and then they hope to grow it out. So I'll be following it closely. We hope to work with them in the future as well. So yeah, shout out to Haraka if you're listening. Keep up the good work.
And I'm wondering, are they using your lending and borrowing solutions? You mentioned that you have this as part of your toolkit.
At the moment, no, but as I said, we were part of the RWA base camp within Outlier Ventures. So we have offered that technology to all of the cohort as they've come through. So at this stage, there's still a proof of concept. We hope that we will work with not only Haraka, but the other projects that have come through too.
Cool. It would be great to hear more about your lending and borrowing solution for RWAs in general, because we don't yet have such a solution ourselves, but we are observing some demand. And just from a theoretical analysis, I see this as potentially being really important for creating liquidity in the market.
Oh, absolutely. It's huge. And, it was actually one of the bases for our partnership, between Defactor and Stobox, because there's certain things that you have, of course, that we don't have. So like DS swap and some of the other concepts that you've got. And with us, it's the lending and borrowing and some other concepts that we hope to be able to bring together and offer to our respective communities. But what we're seeing now, so it's a whole mix, right? We started with testing this out with things like tokenized gold, which is, I guess, maybe one of the easier assets to do this with, because gold has, a global spot price, and you're able to effectively say, no, this is what it's worth. But not only that, a liquid secondary market on this particular project. So if there is a default, and that's always the problem here, how can you reconcile that? How can you make the lenders whole in this situation? So what we have is we have lending technology that kind of goes into two buckets. One of them is basically over collateralized lending, what you would see in the DeFi world. You lock up an amount of tokens. You're then able to take a loan based on a predetermined LTV. You then pay back the tokens with your interest, and then your collateral gets released. And the other side is almost like a counterparty lending pool, where you have to trust the entity, you lend into the pool for a predetermined return. And that could be for things like trade finance assets, it could be for invoice finance, it could be for a lot of things that aren't necessarily tokenized with those bearer assets being on chain. Maybe they're off chain and there has to be a counterparty that sits in the middle. But it's actually the collateralized lending that I'm more excited about, because as we get more of these projects online, you can start to really bring DeFi to RWAs. And it's not really only about liquidity, which is a huge, I guess, area, but it's also with a lot of these RWA tokens, there's quite a long lock-in period. If you buy some of these property tokens or certain things, maybe you can't sell out of that for 2 years or sometimes even more. But maybe you need a liquidity event. You can then lock some of these into a lending contract and take a loan. So there's a whole bunch of benefits why you would do it. Again, we tried to start small, work with some clients that we can really showcase how this works. So we've done it with gold, we've done it with commodities. We're now working with some projects like land shares to do it with real estate. But hopefully going from strength to strength. But what's funny is actually a lot of the projects are coming to us and saying, hey, how do we do this with our project token? Not only with our RWA token, but how can I, say, use STBU or I use factor tokens or I use my whatever the token can be? And that also provides a benefit, because then people aren't selling into the market. Maybe they want to hold these tokens at long term, but they need a liquidity event, or they need to be able to get some cash to do something to then pay it back. So it ends up being kind of a win-win for both the community, but then for the issuer of that token, because there's not as much sell pressure. So we're seeing it kind of on two sides.
Yeah, I have a similar view on that. Generally, when it comes to liquidity, the conclusion I came to is that in order for there to be sufficient liquidity, there has to be multiple avenues for how the tokens can interact. You can go to a decentralized exchange like the swap and sell your token, or you can, especially if you have a large chunk, exchange it on an OTC market, or you can go to the lending protocol and just take a loan against this token. And maybe this is what you would actually need at this point. So I believe we would see a mix of these infrastructures developing, and we'll also see more interoperability and integration work, because even though both us and Defactor, everybody tries to be this one-stop shop with everything, I don't believe this is realistic for one company to rule it all and have all of the solutions and all of the liquidity. So realistically, we would still have each of our specific focus area, what we do best, and therefore there will have to be these interactions and ecosystems in terms of clients, for example, issuing tokens with Stobox, but then creating a lending pool with Defactor, and investor moving between these different systems depending on what their needs are.
Yeah, absolutely. Or what we're trying to explore as well, because as I mentioned, the big challenge with a lot of this lending and borrowing is there a liquid secondary market underneath? So as we're speaking to projects and they say, hey, I want to do lending and borrowing for my, I don't know, name the asset, my tokenized guitars or something. Okay, well, you can do it, but what about if the person doesn't pay back their loan? How do you liquidate those assets? So then we can, for example, go to Stobox and we could say, well, how do we have a liquidity pool on DS Swap? Or how do we have something that if in the event that the person doesn't repay the loan, they can get liquidated on the DEX? There will obviously be some fees and things to be paid, but that then creates a really nice solution. And I couldn't agree with you more, Boris. I think the future is collaboration. We can't and we shouldn't try to take everything on ourselves. Instead, it has to be, hey, I've got this and here's how it works. You say the same, another project says the same, and we come together.
Though I'm still unsure regarding whether all assets will realistically be able to get liquidity. Just currently, if we speak about, let's say, public markets, we have, as far as I know, 600,000 different assets traded worldwide. If we increase it by 1 or even 2 orders of magnitude, then the liquidity for each, but there isn't an increase in the total amount of money in the world that is invested in capital market. There is some increase, but I don't believe it's an order of magnitude. Therefore, either you have a long tail of assets with very, very thin liquidity, or you have just most assets being significantly less liquid, even the largest one. And I believe this is the former one. I believe we will have many, many assets when you may have like two small transactions a year. And I'm afraid that might not be enough for, let's say, for a lending pool, because there won't be any buyers. So I'm not yet sure how this will work. Project owners will have to compete in terms of marketing to attract liquidity, or will there be specialized funds that monitor on-chain information and add liquidity as needed at the moment? So for example, Defactor and Stobox, you can provide lending pool, we can provide a liquidity pool, and then there can be a third player who is liquidity provider and who monitors the on-chain information about assets and provides liquidity as necessary, for example, in the case of a default, because that is their investment strategy. And that's probably the beauty of bringing stuff on chain. Yeah, it might not create liquidity immediately, but it brings it into a system where it can interact with everything else, especially with the current generation of data-rich tokens that contain not only a basic information like here is a token, here is a name, here is the holders, but what kind of asset, what is the history of that asset, price history, etc. What that allows is for these kinds of decisions, liquidity and capital allocation decision being made on chain automatically, and this is what allows capital come into that long tail. Because currently, if you need to have an analyst and have them sit for like 10 hours, 20 hours to analyze a given asset, it is unfeasible to you to allocate small amount, like let's say 5k in liquidity to that asset, because it just doesn't buy the cost of that analyst. But if you can do that on chain algorithmically, then you can start allocating capital to that long tail of assets, and that's where probably the liquidity would be coming from that transparency and automation.
And I think so. And it's really well said, because that is the problem that we're having at the moment. Even with the amount of assets that we currently have, there just isn't a lot of depth or liquidity for a lot of these, no secondary markets. So you can buy into these assets on the primary, but then what? And you either have to try to find somebody OTC to buy these from you, or, it becomes a challenge. And I do know that there are projects that are looking to solve this problem, maybe by having liquidity in one place that can be shared among different pools and utilized as needed. But as you say, that's going to have to happen algorithmically. Maybe with some of the AI concepts that's happening now, we could start to see some of this come into play. So it's certainly exciting, but it's a problem that hasn't been fully solved yet. So as I have a lot of these conversations, and sometimes it kind of comes across as I'm being negative, where when I talk to these property developers or people, they assume that if they tokenize the house or the building, there's going to be a flood of liquidity and there's going to be an active secondary market. And it's like, okay, manage your expectations here, because like I said earlier on, there's big competition, not only with the assets being brought on chain, but the yields being very similar. So a yield for one particular real estate investment trust might be the same for another. How do you fight for that liquidity, or which one wins out? So I do see a future where we have some of these shared liquidity protocols. We also need, and I was just at Singapore Token 2049 and obviously bumped into a lot of market makers, and I was banging the drum to say, do some market making for RWAs, come in here and add some liquidity, and how can we start to work together on that? So let's see. I think the future looks bright, but we're still not there yet.
Yeah, actually, coming back to our previous discussion, I believe this is where institutionals can deliver the most value, because they all have 100 years worth of experience in pricing assets, including in private markets, and in terms of allocating capital, like allocating treasury in a way that earns them additional 0.1% yield. And when you have 100 billion of assets, that is obviously huge anyway. So that experience is probably what we need most to know, what would fit very well the current problem that we are having in the real world assets. And yeah, I also feel like these discussions might sometimes sound negative, like we believe that the industry isn't there yet. But realistically, we are speaking about transitioning the whole of finance, the hundreds of trillions, into a completely new environment. Obviously, that's not gonna come easy. Obviously, there are lots and lots of moving pieces to be built. And this is just a matter, do you have time and patience to come early and benefit from the growth when it comes and when everyone floods in when that infrastructure has already been built.
Yeah, again, I couldn't agree more. I think it's really well said.
One more point I would be very curious to discuss is the topic of regulation, because I've seen, depending on who I speak with, various thoughts on that. And for you, for Defactor, do you see regulation as more of a hindrance to you doing what you want to do, or do you see it as a blessing that enables your business model and operations?
Yeah, that's actually a really good question. And I did a podcast previously where I talked about this. I wondered, while we need regulation, we certainly need to protect investors and make sure that there is not fraud, money laundering, et cetera, et cetera. My fear is that some of these regulations may kind of raise that barrier to entry. So will you have a bunch of innovators, entrepreneurs, smaller projects able to come into the space without having, 100K for legal fees or however much that they need to be able to do this? So I do have a strange relationship with that. Will it stifle the innovation that's coming from projects? And we saw in the .com boom or a lot of this, most people were starting their projects out of their mother's garage or out of the basement, and they're trying to build something that then turns into a massive thing. I want that to happen in our space too. I want there to be a person, as I say, in some place in Southeast Asia that came from very modest means, but they're able to build a unicorn, and they don't get stopped by, oh, well, actually, I don't have enough spend for regulation in the beginning, etc. However, so that's one. So I do think it can stifle innovation, but getting clarity and being able to have a set of standards by which we should operate, having things like MiCA or MiFID across Europe or certain other regulations, they do give a benchmark for projects to know, okay, we have to do, if it's this type of asset, here's how we have to act. So I do think that, again, it's like everything, there's a balance. I don't want things to be over-regulated too much because, again, will that stifle innovation? However, I would like there to be a set of standards by which we know, okay, here's what we can, here's what we can't do. And we're getting there now, a lot better than we were when I came into the space. So now, again, with things like MiCA in Europe, you're able to have a set of standards by which, if you have an asset reference token, this is what you do. If you have another type of token, here's how you do it. So I'm pleased that we're getting there. We are still early. We need more legal precedents. I'm not a lawyer, so please don't take this as legal advice. But we need more legal precedent to say, no, actually, here's how this happens. And again, for protection, you don't want it to become the Wild West where people are just able to invest in everything, etc. But you also don't want to have a situation where if I want to offer my product to the retail market, well, it's not feasible to be able to do a prospectus for every different jurisdiction and to be able to prepare something so that it serves all markets. So probably a long way for me to say yes and no. it can be a hindrance, and especially for smaller projects that are trying to come online. However, one thing that I would advise is work with projects that are already licensed, or work with projects that do have, and they've gone through the regulatory hurdles, they've spoken to the central banks in their place. So that's what we do at Defactor. It's not necessarily that we say, oh yeah, our tech is regulated in every jurisdiction. No, what you need to do is seek your own legal advice for the jurisdiction that you're going to be operating in. And then we can have a series of partners that we work with. You can either use their license or you can work with them to make sure that you're able to launch your token in an efficient way, or be able to use this to your advantage, not to a hindrance.
We have a similar approach, though as we aren't currently focused only on technology, but also assisting clients with other aspects, we are diving somewhat deeper into the legal nuances in each specific jurisdiction, including discussions with central banks and helping clients figure out, okay, how do we get regulated in this jurisdiction, or do we go to another jurisdiction and then do a global offering relying purely on securities exemptions? So even though the regulation definitely somewhat increases, or not somewhat, increases fees, there is a way to comply with it, and there is a way to reduce time to market and cost for the MVP, because there are typically a large number of exemptions that can be utilized, at least for the first stage offering, to get some initial capital and to then grow larger, become regulated, and operate in this fully compliant environment. Also, I believe that this is especially where we as Stobox and Defactor are especially important in terms of enabling that innovation, so that the small entrepreneur in the garage, so that they're able to come to us and they don't have to build full compliance infrastructure, because we have this built and encoded, and they can just rely on the work that we have already done. So in very much sense, by doing this research and by encoding this in the technology, we are part of that process of enabling this broad innovation.
Yeah, that's huge. And that's what we need more of. Again, I'll probably say it a lot on this session, but it's collaboration. You can't do everything yourself. So work with the people that have gotten the headaches and had to sit on all of the calls and answer all of the questionnaires from the different regulators, etc., because that can give you clarity on what your next best move is. And it's, yes, things may change in the coming years, etc., but for now and for everything that we know, these are the people that you should work with. Here is the best practice for issuing your token, launching your token, putting certain protections in place for your holders, etc.
As our interview is coming to the close, I would like to hear what one most important piece of advice would you be able to give to our viewers, many of whom are prospective asset owners and issuers of their own real-world asset tokens?
Oh, that's a good one. So one piece of advice. I mean, I always like to, again, I have said it previously on call, so if people have seen this, I'm sorry, but it's that kind of KISS, keep it simple, stupid. Have a look. If you're an issuer or you're a project that's trying to do something, what are your first best moves that can get you from 0 to 1, that can get you some customer validation, that can get you some product market fit? So on that side, keep it simple. On the other side, on the investor side, I mean, it might sound cliche, but just make sure you're doing correct due diligence and research. We're still in a situation where the crypto market is full of projects that maybe promise the sun and moon and stars, but they don't have it yet. So just make sure that you do your correct due diligence when it comes to, should I buy this asset? You know, what are the rules? How is everything going to be distributed in terms of rewards, etc.? But I don't want to sound too doom and gloom. I think the future looks so bright for this industry. I don't think it's going away. I think it's going to go from strength to strength. But what we need at the moment, and again, I'm seeing it from Stobox, I'm seeing it from some other projects, focus on having a really good UX, a good user experience for people to be able to come on, because it is not a technology problem anymore. It's not. It's a user experience. It's an onboarding. It's a regulatory. These three things are still problems that we need to fully solve to get to that mass adoption. So if I was to make a prediction of what the future looks like, I think it's that. You're going to have really smooth onboarding with really sick UX, and make sure that it's done in a way that it's yes, it complies to the regulation, but that doesn't stifle what you're able to do or how you're able to interact with these assets.
Thank you so much for the advice. And I see that it definitely comes from the direct practical experience working with projects. And Adam, thank you so much for joining this interview, for sharing your experiences and knowledge with our viewers. It was a pleasure to speak with you.
Thank you very much. It was great to be here.
And thank you all the viewers for the time and attention. Please don't forget to subscribe to the channels if you haven't done so yet, to watch other great interviews that we would be making. Follow Stobox and Defactor at our social media, and see you in the next episode.